Welcome back to the deep dive, everyone. This is where we take all that complex research and really boil it down into clear, focused knowledge for you.
That's right. And today, we're tackling Innodata Inc. The ticker is INOD.
Yeah, INOD. You often hear them called the picks and shovels provider for the whole AI revolution that's happening globally.
And just for context, our analysis, all the numbers we're using, they're anchored to September 29, 2025. The closing price that day was $75.94.
Okay, $75.94.
And here's the core puzzle we really need to unpack for you today.
Yeah.
Innodata, they've shown absolutely explosive growth, and their capital efficiency, it's world-class. We're talking a return on invested capital, the ROIC, somewhere between 40% and, get this, 56%.
40 to 56% ROIC. That's incredible proof of how good the business is fundamentally.
Oh.
And this is the hook, right? The market knows this, or at least it thinks it does. It's given Innodata this massive premium valuation.
Right.
Their trailing 12-month PE ratio, it's sitting around 59.3.
Yeah, nearly 60 times earnings.
So can that amazing growth, that incredible ROIC, possibly justify that kind of multiple? Especially, when you factor in these pretty significant legal clouds and competitive threats we found in the sources.
That's the tension. That's exactly what we're going to dig into.
Okay, let's dive into part 1, the foundations of growth. And we'll start with chapter 1, business analysis. The engine room of AI.
Right.
So the market calls them the engine room of AI. What exactly does that engine do? What's the core business here?
Well, fundamentally, Innodata is a global data engineering company. Think of them as critical infrastructure. They're not the ones, building the big AI models like GPT themselves.
Sure.
Instead, they're selling the essential services, the really high-quality data engineering work that you absolutely need to build and train those models effectively.
So they're feeding the beast, basically.
Pretty much.
Yeah.
And their commitment to this AI space is, well, it's total. You can see it clearly in their revenue breakdown. They've got 3 segments, right? But one, the DDS segment, that's Digital Data Solutions, is the powerhouse. It's laser focused on AI, data prep, annotation, that kind of stuff.
And that's where the money is.
Absolutely. In Q2 2025 alone, DDS brought in $50.6 million. That's roughly 87% of the company's entire revenue.
Yeah.
The other segments, Synodex and Agility, they're much smaller in comparison. So, yeah, it's a very concentrated bet on AI continuing its explosive growth.
87%. Wow. Okay. And you mentioned it's not just simple stuff like basic data labeling.
No, not at all. Their services are actually quite sophisticated. We're talking things like supervised fine-tuning, reinforcement learning from human feedback, that's RLHF, and even complex stuff like model safety and red teaming.
Can you quickly unpack those? Like, what's RLHF?
Sure. So, supervised fine-tuning, that's about teaching the model specific skills using human-created examples. RLHF, reinforcement learning from human feedback, that's critical for making AI models align with what humans actually prefer, making them safer, more helpful.
Okay. And red teaming sounds kind of intense.
It is. Think of it like ethical hacking, but for AI models. Innodata's teams actively try to find flaws, biases, ways to break the model, basically.
To make it safer before it goes live.
Exactly. To ensure it's robust, unbiased, and safe for deployment. It's high-value work.
And that level of sophistication, that seems to be their core value proposition, right? This idea of moving from just scale data, huge amounts of data, to delivering smart data.
Precisely. That smart data strategy is really Innodata's competitive moat, their key advantage.
How does that work in practice?
Well, instead of just dumping massive data sets on clients, they act more like strategic partners. They'll actually analyze a client's own proprietary AI model, figure out its specific weaknesses, maybe it hallucinates or it's not factually accurate or it has safety issues, and then they engineer very specific high-quality data sets designed surgically to fix those exact problems. It's much more targeted.
And that partnership approach must be why they have such big names on their client list. The sources mentioned 5 of the Magnificent 7 tech giants use them.
Yeah, that's huge validation. It really confirms their position as a critical enabler in the AI ecosystem.
So what's the unique asset that lets them do this?
It's their operational model, the hybrid approach. They use their own proprietary AI platforms, but they combine that tech with this huge managed global network of over 6,600 human subject matter experts.
Ah, the human in the loop.
Exactly. That combination of AI and specialized human expertise is key. It creates really deep relationships with clients and, importantly, high switching costs. It's not easy for a client to just replicate that whole setup somewhere else.
Okay, that makes sense. Let's move on to chapter 2, management evaluation.
Right.
What's the story with the leadership here?
Well, it's a story of longevity and adaptation. The CEO, Jack Ebuhoff, he's been leading Innodata since way back in 1997.
Since 87, wow.
Yeah. So he's guided the company through some major transformations. They started out more like a digital content provider, and he's steered them to where they are now, this premier data engineering firm focused on AI, this recent explosive growth. It's a direct result of that latest strategic pivot he led.
And how are they using their capital? What's the strategy there?
It's a classic hypergrowth playbook. Management is prioritizing fueling that organic growth above absolutely everything else.
Meaning?
Meaning they don't pay a dividend, they're not doing share buybacks. Pretty much every dollar they generate gets reinvested right back into the business to capture this, enormous AI market opportunity they see.
All gas, no brakes.
You could say that. And this approach, this focus, it brings us right back to that metric we mentioned earlier.
Yeah, ROIC.
Exactly. The quantitative proof of how effective management has been. That TTM return on invested capital, reported between 40% and 56%. I mean, that's truly world-class capital efficiency. It confirms the business is incredibly value additive with every single dollar it reinvests.
Okay. 40-56% ROIC, long-term CEO who pivoted successfully, reinvesting everything. That sounds fantastic.
Okay.
But how do we weigh that against this huge legal risk you mentioned?
Yeah, the elephant in the room.
We're talking investigations by the U.S. Department of Justice, the DOJ, and the Securities and Exchange Commission, the SEC, subpoenas related to their AI claims. I mean, how serious is this? Does this legal cloud just negate all that operational success?
It doesn't negate it, but it creates a massive counterpoint. It's something you absolutely have to consider. You've got this operational mastery on one hand,
Right.
proven by the numbers, but on the other hand, you have really serious legal scrutiny hanging over the company, specifically about the very AI claims that are driving all that growth and valuation. You have to hold those two things in tension.
Okay, a major risk factor then. Let's look at the numbers in Chapter 3, financial analysis.
Let's do it.
So size-wise, market cap is around $2.42 billion, but the growth, the sources called it a hockey stick. Can you detail that?
Oh yeah, it's dramatic. Look at revenue. It jumped from about $87 million in 2023 to over $170 million in 2024. That's 96.4% growth in 1 year.
Wow.
And it didn't stop there. The TTM growth, so trailing 12 months through Q2 2025, actually accelerated even further to a blistering 112.5%.
That's incredible top-line growth, but is it profitable growth? Is it scalable?
Yes, and that's crucial. The profit margins are expanding significantly. Their operating profit margin, TTM, is now around 17.5%. Now, compare that to 2022 when they were actually losing money with a margin of negative 13.3%.
Big turnaround.
Huge turnaround. That expanding margin shows powerful operating leverage. As revenue scales up, more of it's dropping to the bottom line.
And is this translating into actual cash?
It is. Free cash flow, or FCF, has flipped significantly. They were burning cash in 2022, but TTM FCF is now a positive $36.07 million. So real cash is being generated.
And the balance sheet.
The sources describe it as fortress-like. And the numbers back that up. Their debt-to-equity ratio is incredibly low, just 0.05. They have very, very little debt. Practically bulletproof from that perspective.
So financially very strong, growing incredibly fast, highly profitable, which, like we said at the start, brings us right back to that valuation tension.
Exactly, because the market sees all this, and the TTM price-to-earnings ratio is sitting up there at 59.3.
And just to put that in context again.
Right. If you look at maybe some broader peers, companies in data processing or IT services, like, say, Genpact, their PE is around 13.7, or Excel service closer to 30.
Okay, so 1430 versus Innodata at almost 60.
Yeah. It really highlights the huge AI premium the market is currently baking into Innodata's price.
All right, let's shift gears into part 2, market perception and risk. Starting with Chapter 4, market sentiment. What are the analysts saying?
Broadly speaking, Wall Street is optimistic. The consensus rating is actually a strong buy.
Okay.
But there's a pretty wide range in their 12-month price targets. They go from a low of $55 all the way up to $78.75.
And the stock price when we anchored this was $75.94.
Exactly. So it's already trading near the very, very top end of that analyst optimism range. Not much upside left, according to the average target.
Which kind of highlights the disagreement in the market, right? And that's really crystallized by the short interest, isn't it?
Absolutely. The short interest is high. According to the sources, approximately 18.5% of the company's float is sold short.
18.5%. That's significant.
It is. It confirms that Innodata is what you'd call a battleground stock. You've got the bulls betting on that growth story and a very significant number of bearish investors actively betting against the current valuation and maybe those growth claims, given the legal issues.
So a real tug of war. But despite that short pressure, the stock price itself has been strong.
Undeniably, the momentum has been powerful. The stock is trading substantially above both its 50-day moving average, which was around $50.10, and its 200-day moving average, around $44.18. So technically speaking, that signals a pretty robust uptrend, both short-term and long-term, likely fueled by all the enthusiasm around AI.
All right, let's look inside the company with Chapter 5, ownership structure. Who actually owns Innodata stock?
Well, institutional ownership is quite high. It stands at about 53%. And these aren't small funds. We're talking major, sophisticated firms like BlackRock holding 7.0% and Vanguard with 5.7%.
So the big players have conviction.
It suggests they do, yeah. Strong institutional belief in that long-term story that AI adoption will keep fueling Innodata's growth.
What about insiders? Is management aligned with shareholders?
On paper, it looks pretty strong. Insiders own about 3.9% of the company overall. That's an $88 million stake collectively. And the CEO himself, Jack Abuhoff, holds over $80 million worth personally.
Okay, so he's got significant skin in the game. Their interests seem aligned with the share price going up.
You'd think so.
Yeah.
But there's a potential red flag here in the data.
Oh, what's that?
It's the pattern of insider selling. Over the last 12 months, covered by the source material, there was significant net selling by insiders. Get this. 33 sell transactions versus only 6 buy transactions.
Wait, 33 sells versus 6 buys? That's more than a 5-to-1 ratio of selling over buying?
Exactly.
So if this business is so amazing, 50% ROIC, huge AI runway, why are the insiders, the people who know it best, selling so much more than they're buying?
That's the million-dollar question, isn't it?
Yeah.
It's a definite credibility point that the bears will seize on. Why are the people closest to the operations taking profits, especially at these, elevated prices?
It does seem contradictory.
It is. It suggests that maybe, while the fundamentals look strong on the surface, perhaps some insiders feel the valuation has just run too far, too fast, maybe factoring in risks we've discussed. It's definitely something you have to weigh against the CEO's large personal holding. It's a paradox.
A definite point of concern. Okay, let's move to Chapter 6, risk assessment. This is crucial given the high valuation. What are the key threats?
Well, first, there's an operational weakness, customer concentration.
Meaning they rely too much on a few big clients.
Precisely. A significant chunk of their revenue comes from just a small number of very large customers. That makes the company quite vulnerable. If even one of those key relationships scales back or gets terminated, that could have a major impact on revenue.
Okay, concentration risk. What else?
We absolutely have to reiterate the legal and regulatory threats. They need to be front and center in any risk assessment.
The DOJ and SEC investigations.
Yes. And the ongoing class action lawsuits related to their AI claims. It's a material cloud of uncertainty. The outcome of those investigations could seriously impact the stock's perception, maybe even its long-term viability, depending on what they find. It's something financial models have to account for.
Right, you can't just ignore that. Are there other, maybe less obvious risks?
There's an interesting indirect one, geopolitical risk.
How does that affect a data services company?
Well, Innodata itself might not be directly impacted by, say, tariffs between the U.S. and Asia, but think about its major clients, the big tech companies. They're spending billions building out AI infrastructure, right? Data centers, specialized chips, often sourced from Asia. Now, imagine hypothetical U.S. tariffs on semiconductors or critical data center equipment.
That could slow down the AI build-out.
Exactly. If big tech has to slow down its infrastructure spending because of supply chain disruptions or higher costs, then the demand for Innodata's data engineering services, which feed that infrastructure, would almost certainly decrease. It's an indirect but potentially significant hit.
That's a good point. Anything else?
And finally, just the basic mechanics of valuation for a stock like this. As a high-growth company, its valuation is heavily dependent on expectations of massive future earnings way down the road.
Right.
That makes it highly sensitive to interest rates. If interest rates go up, the discount rate used to value those future earnings also goes up. That immediately lowers the present value calculation of those earnings streams.
And puts downward pressure on the stock's valuation multiple.
Correct. So rising rates are a general headwind for high-growth, high-multiple stocks like Innodata.
Okay, that covers the key risks. So let's try to pull it all together in Chapter 7. Conclusion.
Right, let's synthesize.
We have this core conflict, right? The bull case. Absolutely massive, accelerating revenue growth, world-class ROIC between 40 and 56%, this potentially strong, smart data, competitive moat, and a rock-solid, virtually debt-free balance sheet.
That's the bull case. Compelling stuff. But the bear case is equally stark. You've got that extremely high valuation, a PE ratio near 60.
Yeah.
You've got severe customer concentration risk. You have that concerning pattern of heavy insider selling. And looming over everything, that material legal cloud from the government investigations and lawsuits.
So how did our own educational valuation attempt to balance these?
Well, we ran an educational discounted cash flow, or DCF, model based on the source data. Now, to reflect the bull case, we assumed a pretty high growth rate going forward, 35% annually for a period.
Okay, aggressive growth baked in.
Yes. But crucially, to account for all those risks we just discussed, the concentration, the legal issues, the valuation sensitivity, we also used a high discount rate. We applied a range of 15% to 17%.
Which is quite high, reflecting the uncertainty.
Exactly. So balancing that high growth with that high discount rate, the model produced an estimated intrinsic value range for Innodata of roughly $55 to $72 per share.
$55 to $72 per share. And the stock price, as of our analysis date, was $75.94.
Correct. So the current market price was trading above the high end of even our fairly optimistic risk-adjusted educational estimate. It was also above most analyst targets.
So what's the final takeaway then?
The takeaway is that at $75.94, the market seems to be pricing in an extremely optimistic scenario, almost flawless execution going forward. Meaning, investing in IND at that price is effectively placing a big bet. A bet that the company can continue performing at this blistering, near-perfect pace for years to come without any major operational hiccups, without losing key clients, and without those legal investigations turning into something really damaging.
That's a very high bar, a high-stakes balancing act, as you said.
It really is.
Okay. But before we wrap up, you mentioned a provocative thought from the sources, something to leave our listeners mulling over.
Yeah, this comes from the CEO, Jack Abuhoff. He apparently believes that the next big wave in AI, what he calls agentic AI, these are autonomous AI systems that can actually execute complex tasks on their own.
Right, AI agents.
He believes that this rise of agentic AI could create a market for data services that's potentially even larger than the current massive market for just training the foundational large language models.
Wow. So another potential massive tailwind down the road.
Potentially. If he's right, that could be the next growth explosion for a company like Innodata, providing the sophisticated data needed for these autonomous agents. It adds another layer to that high-stakes bet.
Fascinating. So, massive growth, incredible efficiency, but serious risks, and a sky-high valuation already pricing in perfection, with maybe another huge wave on the horizon.
That sums up the dilemma of Innodata pretty well. One of the highest stakes balancing acts in the market today.
Absolutely. Okay, that's our deep dive on INOD. If you found this useful, please do like and subscribe to Stock Analytics AI. For just €4.99 a month, members get priority access to our deep dives. We're planning to cover all the S&P 500 stocks over the next few months, and members get first dibs.
And if you just want a one-off deep dive on a specific ticker you're interested in, dropping us a super thanks is a great way to request it.
Absolutely.
And the important reminder, this deep dive was generated by an AI research system. It's purely for educational and informational purposes. It should definitely not be considered financial advice.
That's right. Please always conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.